Good morning, everyone. Thank you for joining us for Capstone Coffee Conversation. My name is Ryan Skogstad. I'm joined by Brian Felshaw. Tonight, we thought we'd discuss something that's in the media, the print, a little bit more and more as we move through what has been a lot of stability in Federal Reserve rates. So we thought we'd talk about the Fed when it comes to the Fed increasing rates or decreasing rates or keeping rates flat, and then how we see that as impacting us today. So let's kick it off. I thought we'd do a brief intro on just kind of defining the Federal Open Market Committee and what their role is. The Federal Open Market Committee, or you hear called the FOMC often, they meet every 6 weeks, and it's a group made up of 12 managers of the Federal Reserve banks around the United States. There is a chair of the FOMC. That chair today is Jerome Powell. The chair is appointed by the president or nominated by the president and then confirmed by the Senate, and they have a 4-year term. Jerome Powell is in the middle of his second-year term, or in the middle of his second term, and his term will expire in 2026. The FOMC gets together again every 6 weeks. They skip a few different holiday weeks, so they meet fairly often, about every month and a half. What their role is to do is to set the overnight lending rate that banks charge to each other, and that's called the Fed rate. So the overnight lending rate that banks charge, banks lend money overnight to satisfy reserve requirements that are required by the government for banks to hold. So if one bank might be short on reserve requirements, they can borrow from another bank that might have a surplus, and that overnight lending rate is called the Fed funds rate. Now, that Fed funds rate, again, is only a very short-term overnight rate, but that does have some, that does kind of flow through then as that rate can change. Banks then will pass those rates on to customers when it comes to auto loans, mortgage loans, business loans, etc. So the Fed controls only that overnight rate, but then that can start to flow through to other types of loans that banks then charge to customers. A lot of economists look to the Fed for some policy because the Fed has their finger on the pulse of what the economy is doing, and that's how they decide what to set that overnight rate at. And as we've seen in the past, they've kind of held that rate steady. And let's talk about why we're bringing up the Fed today.
So why would we discuss the Federal Reserve today? Well, if we rewind to January of this year, the Federal Reserve had signaled and discussed 3 quarter-point reductions in that overnight lending rate, so 0.75 in total. Well, here we are in September, and they haven't done any of those, as the inflation data that they rely on, it's been a little bit higher than they expected. They expected inflation to fall a little faster and that they could start cutting those rates. They've finally signaled that they feel fairly confident to say that in the month of September, they may begin this rate cutting process, starting with just possibly 1.25% cut. So this is a change in the Federal Reserve's policy, which has been the same since July of 2023. July of last year is when they paused the rate hiking that they were doing to combat inflation. If you remember, back in 2022, we had that 9% inflation summer, and the Federal Reserve was raising interest rates fairly rapidly compared to history. But in July of 2023, they paused it, and they've kept it flat ever since then to today. And now they're looking at possibly starting to cut that. This has a cascading effect on all other interest.
Sorry about that. Technical, I think we lost our internet for a second. So we were just getting into what do rate cuts or pauses in rate cuts or hikes, or what do rate hikes, how do those influence the stock market, or what have they done in the past anyway? So Brian and I looked at about 35 years of data going all the way back basically to 1990 through the different types of Fed cycles. And What we looked at were, if the Fed was hiking, we called that a rate hike cycle. Okay, if they hiked more than once. If they cut rates more than once, we called that a rate cut cycle. And if they held the rates neutral for 6 months, we called that a flat Fed cycle. And so going back to 1990, in those cycles, we covered about 90% of the time. 10% of the time, they might have just cut once, or they might have kept rates flat for only 2 or 3 months, or they might have cut rates once. We didn't really consider that a cycle. But 90% of the time, going back to 1990, the Fed is in some type of kind of prolonged cycle of hiking or cutting or holding rates flat. So what has happened to stocks in each of those cycles? And by stocks, we're going to look at the S&P 500, biggest 500 companies in the US. 52% of the time, or 218 months out of those 420, just over half the time, the Fed is in a flat, neutral cycle, not hiking, not cutting. Okay, it's happy with where rates are today. So just over half the time, Fed stays neutral. The market loves stability. The market has been up more than double the average return when flats are staying normalized. And we can see that in general. Markets like political stability, markets like predictability of how companies are doing, but markets also like stability and predictability of rates. So the return for stocks have been really good, more than double average return in a neutral Fed environment. What happens when Fed is raising rates? When the Fed is raising rates, that's happened about 18% of the time when the Fed's in a hiking cycle, or 74 of those 420 months. So 18% of the time in a hiking cycle, the market returns about average. So if we think about, okay, the Fed's raising rates, typically the Fed's raising rates when the economy is pretty darn good. Now, raising rates would typically mean it's getting harder for stocks, harder for consumers, but the backdrop is usually in a good economy. So even though it's raising rates, the economy is typically doing just fine. So the average return for stocks has been felt in a hiking cycle. You get about an average return. On the flip side, we looked at what happens when the Fed is cutting rates for stocks. Well, that happens about 20% of the time. Okay, so you have about 50% of the time rates are kind of neutral, about 20% they're going up, 20% they're going down, and about 10% of the time there's just little movements here or there that doesn't really account for a cycle. But in those rate cutting cycles, 20% of the time, the market has had a negative 5-6% return. So a marginally a little bit negative return in those rate cutting cycles. And so that kind of leads us to now where we're at today. I'll pass it back to Brian, but there's some definite divergence of how returns do in the different types of cycles.
Yeah, it's fascinating to see just the market reaction to those different types of rate hiking or cutting cycles. Before the notion of negative returns in a rate cutting cycle scares you off, let's dissect that a little bit and ask ourselves why. Historically, we see the Fed cutting rates in a reaction to something that's wrong with the economy, something that's breaking, a bubble that's bursting, markets in turmoil, and they typically come to the rescue, so to speak, is the way we say it. So it's not that stocks go down because of a rate cut necessarily. It's usually historically been correlated with a time of economic turmoil, and the Fed is also cutting while the market's having a hard time. So we have to make sure we understand that it's not a one-for-one causation. They typically happen at the same time. That does beg the question, though, where are we today? So we talked earlier a little bit about the Fed being restrictive right now with their policy rate, that they have purposely made it very high to get a handle on inflation. As inflation has come down, they start to ask themselves, at what point do they dial that back? And that's what they're talking about today. And that's why we're talking about it today. The question for the Federal Reserve that they're asking themselves now is, they know when they make a move in interest rates, that is not really felt in the economy until several months later. Usually we just say about 6 months later. So just as they knew as they started to raise rates, that would take some time to play out. They also know that as they cut rates, that's going to take some time to play out as well. So as they look at the data, that inflation has come down, unemployment maybe has ticked up a little bit compared to where it was a year ago. They're starting to think 6 months down the line and say, how do we act now to prevent starting to cut rates when there's already damage being done? And that's the conversations they're having right now, because that's what they want to prevent over the next 6 months. What does that mean for investments? Well, there's a lot of uncertainty there. Are they going to be able to thread the needle and create the soft landing that we keep hearing about? That's a question mark. And so as an investor, what we typically have been talking about for, gosh, about a year now, is staying away from companies or assets that might be considered a little bit of a bubble, a little bit higher in their values compared to their historical averages. Because let's say they don't land the plane well, they don't have a soft landing. What kind of investments are going to have a hard time with that? It's going to be companies that might be in a little bit of a bubble. So as advisors, we look at that, we try to help clients be diversified, make sure that we're being wary of if we're getting into areas that are a little overvalued, what's undervalued, because there's question marks around that, that they could do it, but we don't know what's going to happen for sure, and neither does the Federal Reserve. Hopefully, as we start this cycle, there would be more cuts to get back to what the Federal Reserve consider as a normal policy rate. Not tight, but not low either, because we're in difficult times. They want to get back to a normal rate because, as we know, the markets like stability of rates.
Yeah. And when you kind of go back to that data and kind of looking at where we're at today, many of the times that we have seen cuts have been some of the worst market times in history. The financial crisis, we're cutting rates, stocks were declining a tremendous amount. The tech bubble, we're cutting rates, the stocks were declining a tremendous amount. So sometimes those numbers are skewed, and I hate to use the term, this time it's different, but hopefully this time might be a little bit different as we go forward, but always something that we're trying to keep an eye on, and what the Fed decreasing rates today means versus when it was cutting rates at a different time in the past.
That's right. That's right. Well, let's see if we have any questions from the group.
Got one for you. Does the Federal Reserve cutting rates have anything to do with the election?
The Fed is a independent organization, even though it's nominated, the Fed Reserve Chair is nominated by the president and confirmed by the Senate. They are, they don't kind of change hand. Like I mentioned before, Jerome Powell is in his second term, was appointed by President Trump and then again by President Biden. So they are an independent organization. So they try to stay out of the kind of political discussions. Typically, around an election, the Fed tries to stay neutral to try and not influence an election. But Jerome Powell has kind of signified he's going to do what is best for the economy today, and he's not really taking the election into account. So typically, some would argue, would they typically cut or raise rates around this time, 2 months out from an election? This gets about to be the period where a lot of times they won't, but I think he has kind of been very transparent, and I would not be surprised to see a rate cut next week when the Fed meets. But Jerome Powell has tried to walk the line of we're doing best, what's right, and not worry about what's going to happen in the election.
Yeah, good question. Okay. Well, if you have any other questions, please feel free to reach out to your advisor and talk more about this and how this might impact you. We're happy to have you be here, and we'll see you next month.
Thank you.